Two of the nation's biggest banks reported their third quarter results today. The numbers are closely watched, in part because the financials are the second biggest component of the S&P 500. The Dow component, JP Morgan, posted its first loss ever under CEO Jamie Dimon. It lost $380 million as the bank set aside more than $9 billion to cover legal costs. Strip out those charges, and the bank actually beat Wall Street predictions with a profit of $1.42 a share, or $5.8 billion. Wells Fargo also posted a profit, 99 cents a share, or $5.6 billion. That was 2 cents ahead of expectations. Here with more analysis on the banks is Brad Hintz, equity research analyst at Sanford C. Bernstein. Mr. Hintz, welcome. Good to see you. Let's talk a little bit here, if we might, about JP Morgan. $9.2 billion charge in this quarter. The company told the market that they have $23 billion in total legal reserves, and it's possible that they could exceed that amount by nearly $7 billion. That's stunning, isn't it?
Well, I think what you have here is a bank that is attempting to tell the market we're well reserved. This, the $9 billion we put away today puts us in a good position for whatever could happen going forward. And it's really trying to settle with the government. You could hear it from the tonality that in terms of how the CEO spoke. When asked about regulation, he said, "We will comply." So to me, this is JP Morgan saying, let's negotiate, let's get this behind us. And that's really one of the positives on JPM. JPM has actually underperformed, if you look at relative to the other banks, over the last 6 months or so. A lot of this is the regulatory overhang. So, what JPM's management is doing is saying, here's the number, analysts, you don't have to worry about it now.
All right. So really two related questions. First, on JP Morgan, are you recommending the stock? Would you buy it at 52?
I think the issue, we haven't outperformed on JPM. To me, from a timing point of view, the issue is this is a stock that will do extremely well once the settlement is behind it. Okay. The overhang of the regulatory charges, the concern about them from a litigation point of view, has really pushed down this stock. This is a leading investment bank in a recovering economy. So, extremely well-run place.
What I wanted to ask you, Brad, the follow-up on that is that this conversation around JP Morgan reminds me a lot about all the litigation problems that were going on with Bank of America, even just recently, and people were fleeing from that stock. So is JP Morgan still a buy, or is Bank of America a better one? Because its legal problems are pretty much behind it.
JPM has certainly been hurt worse. So it strikes me as JPM, and actually the analogy that I would use is Goldman Sachs. Both JPM and Goldman Sachs were really the leading banks, and as the leading banks, unfortunately, you're the one who gets shot at by the regulators. In terms of regulation, the issue here is to make sure that Wall Street finds out who's in control. And that's very much what's going on here. Yes, there were problems in terms of the mortgage-backed business, but JPM, the well-run firm, is the one that's being focused here.
Talk to us a little bit about the changing sort of environment in which banks are doing business today. Interest rates have been rising. The other bank that came out with its numbers today, Wells Fargo, the largest mortgage originator, but taken with Chase, the two largest. How is that changing their business? And when you look into their segments, fixed income, commodities and currencies, that wasn't doing all that well. Trading wasn't doing all that well. Investment banking wasn't doing all that well. Are we looking at a changing environment for the big banks?
Well, certainly on the trading side you are. On the trading side, what you're seeing is less risk, more capital. That brings the ROEs of the businesses down. A much tighter risk management culture. This slows down decision making. Now, we are in a transition stage, and that transition stage is we're trying to learn how to live in that environment. And what will happen is bid-offer spreads will open up. In other words, the cost of doing trades will become more expensive. The markets will become somewhat less liquid. The street will learn to operate with less capital. But this transition phase means that you're generating relatively low returns on the trading business. There are only two banks in the world that are beating their cost of capital in terms of trading. That's Goldman Sachs and JPM. The rest are still in this learning stage, and it could be 18 months.
Very interesting time for the banks. Mr. Hintz, thank you very much.
Pleasure.
Brad Hintz is equity research analyst at Sanford C. Bernstein.